Hello traders, welcome back to our channel. In this video we are going to show Wyckoff schematic principles in correlation with our strategy. Richard Wyckoff was an early 20th century pioneer in the technical approach to studying the stock market. We have not used very often the exact Wyckoff approach, but our strategy is based in supply and demand, and they have a lot of similarity regarding to the entry levels. Before digging more into that, we are going to show how we started our forecast. This is a setup shared on Premium channel in October. We made a top-down analysis from daily to 1 hour time frame. We are highlighting the supply and demand zones as always do. Looking at the left of the chart, we have 3 supply zones. The first one was broken, and now price is staying inside the second one, that is closed with the last one. Price is creating an AB equals CD pattern, not a perfect one, but still valid. When we highlight the daily session volume, we noticed that for each supply we had a fresh point of control level. As we can see, there is no guarantee that price will reject these levels. It has high probability that we will, but we must find other correlations that confirms the sentiment. One simple and effective way is to shift on lower time frame and look for break of structure that can confirm a reversal. In our uptrend, if we are looking for a reversal, we must highlight the higher low and wait for the break of the last one. On the third supply zone we have a lot of bearish pressure. Price eventually touched zone and we was waiting for the break of structure. Price dropped sharply but didn't break it. Instead it created a equal lows, or you can call it double bottom in an uptrend. Looking at price action, we noticed that price was creating a large distribution, and the best to describe it is Wyckoff schematic. Make sure to like and subscribe. This encourages us to make more helpful videos. Wyckoff price cycle. According to Wyckoff, the market can be understood and anticipated through detailed analysis of supply and demand, which can be ascertained from studying price action, volume and time. As a broker, he was in a position to observe the activities of highly successful individuals and groups who dominated specific issues. Consequently, he was able to decipher, via the use of what he called bar and figure charts, the future intentions of those large interests. An idealized schematic of how he conceptualized the large interests' preparation for and execution of bull and bear markets is depicted in the figure. The time to enter long orders is towards the end of the preparation for a price markup or bull market, accumulation of large lines of stock, while the time to initiate short positions is at the end of the preparation for price markdown. Let's explain the distribution Wyckoff events. PSY, preliminary supply, where large interests begin to unload shares in quantity after a pronounced up move. Volume expands and price spread widens, signaling that a change in trend may be approaching. BC, buying climax, during which there are often marked increases in volume and price spread. The force of buying reaches a climax, with heavy or urgent buying by the public being filled by professional interests at prices near a top. A BC often coincides with a good news, since the large operators require huge demand from the public to sell their positions without depressing the price. AR, automatic reaction. With intense buying substantially diminished after the BC and heavy supply continuing, an automatic reaction takes place. The low of this sell-off helps define the lower boundary of the distribution trading range. ST, secondary test, in which price revisits the area of the BC to test the demand-supply balance at these price levels. For a top to be confirmed, supply must outweigh demand, volume and spread should thus decrease as price approaches the resistance area of the BC. And secondary test may take the form of an upthrust, in which price moves above the resistance represented by the BC and possibly other secondary test, before quickly reversing to close below resistance. After or upthrust, price often tests the lower boundary of the trading range. SOW, sign of weakness, observable as a down move to, or slightly past, the lower boundary of the trading range, usually occurring on increased spread and volume. The automatic reaction and the initial sign of weakness indicate a change of character in the price action of the pair. Supply is now dominant. UTAD, it's upthrust after distribution. It's the distributional counterpart to the spring and terminal shakeout in the accumulation trading range. It occurs in the latter stages of the trading range and provides a definitive test of new demand after a breakout above trading range resistance. Analogous to springs and shakeouts, a upthrust after distribution is not a required structural element. The trading range in distribution schematic number 1 contains a upthrust after distribution, while the trading range in distribution schematic number 2 does not. LPSY last point of supply. After testing support on a sign of weakness, a feeble rally on narrow spread shows that the market is having considerable difficulty advancing. This inability to rally may be due to weak demand, substantial supply, or both. Last point of supply represent exhaustion of demand and the last waves of large operators' distribution before markdown begins in earnest. If you want to learn more about our strategy and be part of Premium Channel, we offer a mentorship program. Check the link on the description to find more information. Let's get back to our chart to apply these principles to our chart. The first is preliminary supply. We move on with buying climax, automatic reaction and secondary test. All these events together create the phase A. The phase A in a distribution trading range marks the stopping of the prior uptrend. Up to this point, demand has been dominant, and the first significant evidence of supply entering the market is provided by preliminary supply and the buying climax. These events are usually followed by an automatic reaction and a secondary test of the BC, often upon diminished volume. However, the uptrend may also terminate without climactic action, instead demonstrating exhaustion of demand with decreasing spread and volume. Less upward progress is made on each rally before significant supply emerges. In a redistribution trading range within a larger downtrend, phase A may look more like the start of an accumulation trading range. However, phases B through E of a redistribution trading range can be analyzed in a similar manner to the distribution trading range at the market top. Next events are snow below the automatic reaction and the upthrust. These events together create the phase B. The function of phase B is to build a cause in preparation for a new downtrend. During this time, institutions and large professional interests are disposing of their long inventory and initiating short positions in anticipation of the next markdown. The points about phase B in distribution: the large interests are net sellers of shares as the trading range evolves, with the goal of exhausting as much of the remaining demand as possible. This process leaves clues that the supply-demand balance has tilted towards supply instead of demand. For instance, signs of weakness are usually accompanied by significantly increased spread and volume to the downside. Recommended broker is Longhorn FX. Trade a wide variety of assets with leverage up to 1 to 500. The next event is upthrust after distribution. This event creates the phase C. It is a price move above trading range resistance that quickly reverses and closes in the trading range. This is a test of the remaining demand. It is also a bull trap. It appears to signal the resumption of the uptrend, but in reality is intended to uninformed breakout traders. An upthrust or upthrust after distribution allows large interests to mislead the public about the future trend direction and, subsequently, sell additional shares at elevated prices to such breakout traders and investors before the markdown begins. In addition, a upthrust after distribution may induce smaller traders in short positions to cover and surrender their shares to the larger interests who have engineered this move. As the price developed, we have another upthrust that made us reevaluate all the past events and the future forecast of the price. Aggressive traders may wish to initiate short positions after a upthrust or upthrust after distribution. The risk-reward ratio is often quite favorable. However, the smart money repeatedly stops out traders who initiate such short positions with one up thrust after another, as happened in this setup, so it is often safer to wait until phase D and last point of supply. Price continued in downside direction and closed below the support level. This event is no sign of weakness. Phase D arrives after the tests in phase C show us the last gasps of demand. During phase D, price travels to or through trading range support. The evidence that supply is clearly dominant increases either with a clear break of support or with a decline below the midpoint of the trading range after a up thrust. There are often multiple weak rallies within phase D. These last point of supplies represent excellent opportunities to initiate or add to profitable short positions. In our example, price made several pullbacks at supply zone. Phase E depicts the unfolding of the downtrend, the stock leaves the trading range, and supply is in control. Once trading range support is broken on a major sign of weakness, this breakdown is often tested with a rally that fails at or near support. This also represents a high probability opportunity to sell short. Subsequent rallies during the markdown are usually feeble. Traders who have taken short positions can trail their stops as price declines. After a significant down move, climactic action may signal the beginning of a redistribution trading range or of accumulation.